Hello, everybody. Thank you for joining today. I'm going to give a bit of a background on the kind of performance of the funds. Before I do that, I thought maybe it's worth setting the scene in terms of performance over the last year and a bit, in terms of how that's kind of fared for different asset classes and markets, a bit of a macroeconomic and market outlook, and then dive into what that means for the funds themselves. In terms of performance and positioning, and what we're doing, looking forward from today. So, just as a bit of a recap in terms of performance for the kind of US dollar financial markets over 2022. And the reason for focusing on 2022 is it's probably one of the worst years we will have seen in most of our investment lifetimes. The picture on screen is just showing you what happened in equity markets around the world over last year. And you can see that the problems really started in the first month of 2022, where you saw a sell-off across pretty much every single stock market around the world. And that was all down to interest rates, and specifically the fear that interest rates were going to have to rise quite sharply, quite quickly, to try and counter the level of inflation that we'd started to see post the pandemic. And if you think that if you invest in a company or you invest in a stock market, all you're doing is investing into a series of cash flows into the future, if the rate of interest goes up, it's not necessarily a surprise that the value of a stock market or a company goes down. And that's exactly what we saw, that interest rates started to rise, stock markets started to fall, to the point where the Nasdaq 100, which is that deep purple line on screen, was down almost 15% in the first month of 2022. The Nasdaq being a much more technology focused stock market, much more exposed to technology related stocks that are growing quite quickly and therefore quite susceptible to that issue. Kind of fast forward to February and March, and we saw a further sell-off in markets. And this was down to the Russian invasion of Ukraine, which is horrible for all sorts of reasons, but specifically when it comes to financial markets, has just added further fuel to the fire around inflation. Russia is a very big producer of energy to the Western world, particularly Europe, and Ukraine a big producer of food to the developing world. And both those components, energy and food, are quite large and quite volatile components of the overall inflation picture. And so the invasion has just led to further uncertainty around how long inflation is going to be with us, when it may peak, when it may moderate, and what it might actually finally, bottom out or top out as. And markets generally hate uncertainty, and all that invasion has done is create further uncertainty. So again, not necessarily a surprise that we saw a sell-off post that. And then, we moved forward through to the summer and we saw markets really hit their bottom. And this is down to the combination of the fact that when you have periods of high inflation and higher interest rates, that normally leads to a slowdown in economic growth, potentially a recession in different parts of the world. The last time we saw that, it was the 1970s. And all a recessionary environment is further uncertainty for companies, for consumers. And again, markets hate uncertainty. So perhaps not a surprise that we see markets selling off. Markets hit their bottom at the end of June. And then even though it doesn't really look like it, we've actually seen a bit of a recovery in most major stock markets since then, on the back of actually some worsening economic news. So that says to us that actually a lot of what we saw last year in terms of share price movements was down to sentiment as opposed to fundamentals. It's about people worrying about what was going to happen, to what was actually happening underneath the bonnet, because most companies, and certainly the case for the funds that I manage, actually saw very, very good levels of growth last year in their profits, in their revenues, in their cash flows, and therefore, in a period where sentiment is driving markets, we think the best thing to do is to stay invested and weather that kind of period of turbulence, because sentiment can turn quite quickly. And in 2023, it already has. We've seen a sustained recovery in the first couple of months of this year and the latter half of last year, and portfolios are off their bottoms already. The story of 2022, though, isn't one just of stock markets. It really was one of what happened in the non-equity space, in what's typically seen as the lower risk part of people's portfolios, the bond market. And we saw one of the worst sell-offs we'd seen in history in 2022 when we look at either government bonds or corporate bonds. So on screen, we're just showing you global government bonds in dollars and global corporate bonds in dollars, both down just under 17% for the year. In the US, you can go back to the 1780s when George Washington was in power, to find a year that was worse for bond investors based out in the United States. What we saw last year was almost without kind of historical precedent. And if you think this is the area of the market that most people look to invest into, to try and protect capital, generate an income. You could actually, in a perverse situation last year, that you would have been almost worse off investing into this space than in the higher risk equity markets. In big contrast to 2008, where stock markets were selling off, you could have sold out of your stocks and bought bonds, and that would have offered you some protection. In 2022, it offered you almost no protection whatsoever. Just to show you how rare an event that is, we call this chart the sneeze chart. Every dot on here represents a calendar year return for US treasuries, US bonds, and US stocks along the bottom. So, as taking as an example, this dot where my mouse is highlighting at the moment is a year where US treasuries were up 20% and US stocks were down just over 30%. So a good year for bonds, a bad year for stocks. What you normally see is that they offer you some diversification. Only one asset class you when the other one falls out of bed. There's only ever been 5 calendar years in the last 150 where you've seen both bonds and stocks falling together. So what we saw last year was, the last time it happened was 1969, and you can see that before that it was the 1930s kind of depression period. So real kind of periods of economic stress, which we see last year. And you can also see that by 2022, by the scale or the quantum of the falls, was the worst we've seen in history. So if 2022 felt like a bad year to be invested, it felt like a bad year for financial markets, that's because it was. But that has led to, we think, to some silver linings when it comes to allocating capital today, because valuations across most classes, have corrected. And so, what we're thinking about the world as we step forward into 2023 is that we're definitely in a more challenged place than we were previously. We think 2022 was the end of what we called the new normal period, existed post the financial crisis in 2008. That world of ultra low interest rates globally, quantitative easing, printing by central banks of just more and more money to try and protect the economy, came to an abrupt halt in 2022. Money is no longer free. The cost of borrowing is as high as it has been for over 15 years. And that's going to have some long-term consequences for investors and for borrowers that we're yet to start to see. We think there's some good signs that developed economies world are starting to slow down in terms of economic growth. That combination of inflation and higher interest rates, we think, is going to lead to a slowing economic environment in the months ahead. Not necessarily predicting a recession in every region, but definitely a much tougher time economically. We think that favours the investment approach we have in the funds, and we'll go into a bit more detail later on, but we're always focused on high quality businesses that don't need the world to be doing well for them to be doing well. We don't need economic growth in our portfolio for our companies to keep on growing their profits, their cash flows, and their dividends for investors. Inflation, which has obviously been hitting headlines globally, we're expecting to moderate in the months ahead, still potentially remain elevated compared to how it has been historically, but some of those drivers of inflation we're expecting to lessen over the next few months because of what we've seen in the last 12 months. We'll go into a bit of detail on that in a second. And when it comes to interest rates, which has obviously been what's caused most of the pain in financial markets over 2022, we think there are real reasons to believe that it's hard for central banks to continue to raise interest rates at the same speed, the same pace as they have been over the past 12 months. Again, we'll go into that in a bit more detail. And whilst a lot has changed economically over 2022, actually some things still remain. And these long-term issues that have been with us since the financial crisis in 2008 still remain. And that's one of the world is very, very indebted. Debt globally remains very, very high by historical standards. And demographics are worsening. People are starting to age. People's percentage of working age populations are decreasing. And both those things combined, high debt and worsening demographics, we think lead to an anemic economic growth environment as we look forward from today. What does that mean for markets? Well, we think it's really important at this time, as we enter 2023, to distinguish between the short term, what the next few months look like, and the long-term prospect for kind of investment markets, both stock and bond markets. In the short term, we're expecting volatility across all asset classes to remain high. We think it's really unlikely that we'll see a prolonged recovery in stock markets, especially until inflation starts to soften. And once inflation starts to soften, central banks can take their foot off the gas when it comes to interest rate rises, and that hopefully will make it a much more comfortable environment for stock markets going forward. Slowing economic growth is going to hurt different sectors of the stock market in different ways, but it's especially going to be harmful for highly cyclical sectors like energy, like real estate, like the banking sector, areas that we never invest into within the funds. We think more than ever you want to be hunting with a rifle rather than a shotgun in this environment. And quality of cash flows, the quality of the underlying business is more important than it ever has been. However, for investors that can take a long-term view and can look forward through the next few months of volatility, we think valuations across both stock markets and bond markets are pointing to some really good long-term outcomes. When we look back at kind of where equities are today compared to history, they point to really good high levels of annualized returns over the next 10 years. And the same for bond markets, which has not been the case for the last 15 years. For the first time since the financial crisis in 2008, the yields on offer from bond markets are offering you potential returns, in some cases in excess of inflation, but also giving you levels, of return not seen for almost 20 years, which for multi-asset investors, such as we are for the funds, gives us a huge amount of opportunity to go at. So in some ways, we're probably more excited than we ever have been, even if the world is a bit more of a challenge place in 2023. Just putting some meat on the bones of kind of all those points I've just made and going to a few of those points in a bit more detail. The big change of 2022 was this return to what we're calling the old normal environment that was with us prior to the 2008 financial crisis, the end of the new normal environment. The cost of capital, the cost of interest rates is now back up to the levels last seen in 2007. And what caused a lot of the pain last year was the speed of that change. Money is no longer free. You can't just throw 1,000 darts at the board and 2 or 3 of those things will hit and give you a good return. You've got to be more selective in an environment where interest rates are higher. We don't think anything better encapsulates that kind of period of new normal than the era of negatively yielding debt. The concept where you would lend money to a government or lend money to a corporation and expect to receive less money back. You are paying for the privilege of lending someone money. In Denmark, during that period, you could actually go and get a negatively yielding mortgage, where the bank would actually pay you as the homeowner to borrow, which is staggering when you think about it. At the height of 2021, there was $18 trillion of negatively yielding debt out there in the world. It had taken about 8 years to get to that point. In the space of 12 months, we've gone back to zero. The world of negatively yielding debt has ended very abruptly. And we think nothing signals the change of the environment better than that unwinding. Looking forward from today, we're expecting inflation to moderate. Why do we say that? Well, commodity prices have come off significantly from their peak. On the left-hand side, we're just showing you different commodity prices, whether it be natural gas or wheat, the price of copper or corn. All of those are down quite significantly from their 2022 peaks. These things have been feeding into the inflation numbers globally over the past 2-3 years, and these will now start to feed into the inflation numbers going forward. So we're expecting a moderation when it comes to that. But secondly, some of the kind of supply chain issues that have been with us post the pandemic have moderated quite significantly as well. So a statistic I'm sure everyone was paying attention to in 2019, the cost of shipping a 40-foot container around the world from China. It used to cost you about $2,500 prior to the pandemic. And in the middle of 2021, post all these supply chain issues that everyone was facing, that had got up to the mid $20,000 level. That's come all the way back now to where it was prior to the pandemic period, and that will start to again feed into the inflation numbers as we move forward from today. We're not saying that inflation is going away. We think there's some reasons why inflation will be structurally higher in the years ahead than it has been previously, because wage growth is starting to come through. But actually some of the shorter term and some of the more intransigent drivers of inflation have definitely softened over the past few months. And we think that's a real positive as we look forward from today. When it comes to interest rates, we do believe that the pace of interest rate rises is going to soften through 2023. The reason we say that is this chart on the left-hand side. So what we've highlighted here is the Volcker shock period, we're calling it, where the US took interest rates to 20% between 1979 and 1981 to try and deal with the levels of inflation they'd been seeing in the 1970s. Now, they could do that back then because debt to GDP stood at 31% of total economic output. Today, it stands at 120%. So the ability of authorities to raise interest rates meaningfully from here without something in the economy breaking, we think is much diminished. It's not to say we won't see further interest rate rises in 2023, but we think it's hard to constant the level of raises we've been seeing in the last 12 months being repeated going forward because the economy just simply isn't strong enough. And whilst a lot has changed, some issues still definitely remain, and that's that debt globally remains very, very high. On the left-hand side, we can see debt to GDP for governments across the world since 2007 through to 2022. And just picking out the US, debt to GDP stood at 65% just prior to the global financial crisis. It's 120 odd percent today. Just like you and I, if we have a lot of debt, we've got not many options to spend on other things. It's the same for governments, which make up a big part of the economic growth picture. So debt being high is an anchor on economic growth being high. And on the right-hand side, just to be very, very optimistic, the demographic picture around the world is pretty poor as well. The working age populations of pretty much every major economy is expected to shrink over the next 30 years. On the right hand side, we're just showing you the percentage of a population of working age as predicted by the United Nations looking forward from today. And you can see pretty much across the board, they're expected to decrease. But people are living longer. And so you're going to end up with a situation where you've got more people demanding things from society, but less people producing things. And that combination is not normally good for economic growth. So we think this combination of high debt and worsening demographics is going to keep a lid on economic growth as we look forward from today. And that's very similar to what the period we've seen in the last 15 years. For us, that means you need to be tied into companies that don't need the world to be doing well for the companies to do well. That's how we always invest our capital, but we think that's going to be more important than ever in the years ahead. Just fleshing out some of the work around or some of the things I said about markets, why do we think the short term could still end up being a bit turbulent? We went into a bear market in the United States in 2022, a bear market just being a peak to trough fall of more than 20%. We saw a fall from January to June last year of just under 24%. This table is just showing you every bear market the US has witnessed since the end of the Second World War. The falls we saw last year have been some of the shortest and shallowest compared to history. It's not, therefore we've got a healthy dose of skepticism that we're out of the woods as we sit here today. We think there's still, the capacity for some further turbulence as we look forward from today over the next few months. We think the catalyst for that turbulence going away is inflation moderating and is interest rates starting to soften in terms of their rate of change. But for long-term investors, we think there's some real reasons to be optimistic when it comes to allocating to stock markets. This is just one of the return models we use within the firm for predicting what the long-term returns are likely to be for the global stock market. So it looks over the next 10 years. The purple line is the most relevant. And that purple line is just showing you what the indicated 10-year annualized return is likely to be at any moment in time. And as we sit here today, it's looking like an 8.5% percentage return per annum over the next 10 years, which compares really favorably to history. You can see how low it got at the end of 2021. So for long-term investors, which we are, and we hope you are as well, we think it's a pretty good time to be allocating capital to equity markets because the long-term returns are looking pretty compelling. And the same goes for bond markets. This is just showing you the yield to maturity on US Treasuries and US dollar corporate bonds as we sit here today. The yield to maturity is your best indicator of future returns. And you can see that compared to history, this is just going back 20 years, the yields on offer on both corporate debt and government debt are as high as they have been for quite some time. We can go and lend to a US corporate today and expect to get a per annum return of just under 6%. We go and lend to the US government, we should be expecting a return of about 4.4% per annum. And therefore, bonds are going to be a much bigger part of our portfolios moving forward. We still think we'll get a better return over the long term from stocks and shares, but actually returns from bonds today will also be higher as well. So for multi-asset investors, it's a pretty exciting time to be allocating capital. What does that mean for the funds and for the MPS portfolios that I look after? Well, perhaps no surprise that last year, given how turbulent financial markets were, we saw a negative return across all models. But they were slightly better than our peers in the investment management industry. We still managed to protect capital. We still fell a lot less than wider stock markets, and we still fell a lot less than wider bond markets. And we've started to see a recovery in returns over the last few months that we're expecting to continue over the next few months, without having to have changed our spots in terms of how we invest. How are the funds positioned today? There are three underlying global funds that I manage that make up the MPS portfolios: conservative, balanced, and adventurous. As you move up the fund range, the amount we have invested in stocks and shares increases. The amount we have invested in the non-equity component, which is typically bonds, some gold, and some absolute return funds, decreases. In pretty much every single fund, we are at the maximum we can be in terms of allocation to stocks and shares, because of the reasons I kind of just went into. We're still expecting over the next 5 to 10 years, stocks and shares to give us the best risk-adjusted return based on the valuations we're buying some of these companies on today. But equally, we can start being a bit more aggressive in the bonds that we own for you as well, in that we're expecting them to give a much better return than they have done historically. So cash, we're keeping very, very low. We're allocating to corporate bonds and to government bonds. In the government bond space, that's really been inflation-linked debt in the last few months. So bonds where they pay out a return which is linked to inflation. And for the first time in a long time, that's offering us a positive return ahead of inflation. We have a percentage allocation to gold across all of the funds as well. One of the few asset classes we believe out there that are able to grow capital ahead of inflation over the long term, but also gives us protection if we see further turbulence in either bond markets or stock markets looking ahead. We tend to be focused only in three kind of global stock markets as we sit here today: the UK, US, and Europe, but multiple countries make up that European equity allocation. And I'll just take you into a bit of detail about what that equity allocation looks like as we sit here today. So we were relatively active in the funds over the last 12 months. We normally make one or two changes to the equity portfolio within the funds in a normal period. Last year, we sold 3 companies and we purchased 3 companies. So we're about 3 times more active than we normally would be. And that was really to take advantage of the turbulence we've been seeing in markets. In pretty much every case, what we did was trade out of a company that was pretty defensive in nature, but where valuations had started to get quite toppy. And we started to buy into companies that had seen quite precipitous falls. So whether it be Amazon, Louis Vuitton, Moet Hennessy, or Adobe, all of which I think at the time of purchase were down about 30% for the year. And we're on valuations that were in line, we thought, with market, but were giving us much better kind of future growth prospects than the wider market, and much better future growth prospects than the companies that we were selling out of. And we'll go into a bit of detail on a couple of those purchases later on in the presentation. The equity component as we sit here today is made up of 27 businesses. There's a common thread that runs through all of those companies, though, in that they all have advantages that are difficult to replicate. So whether that's strong brands, so a business like LVMH, which was one of our purchases last year, the 8th largest company in the equity component, whether it's an installed base of software, so a company like Microsoft, where 1 billion people are using its products every day, and those products are mission critical to most people's daily lives, or it's intellectual property, so a business like Novo Nordisk, where it's the world's largest producer of insulin, but equally has got one of the only drugs out there today that is clinically proven to reduce and remove obesity. And that's a huge demand area as in an aging population. So there's something that means that all of those companies produce something that others can't. It means that clients and customers come back to them day in, day out, month in, month out, week in, week out, almost irrespective of what's going on in the wider world. And they are willing to pay whatever the company sets as the price of their product. You know, these companies have all got pricing power, and we'll go into a bit of detail on that in the next slide. In terms of sectors, our allocation always tends to be focused on, you know, high quality businesses that can generate kind of consistent cash flows over time. They tend to be found in the consumer staples sector, so businesses like Unilever or Procter and Gamble, you know, making Ben and Jerry's ice cream or Dove soap, or in the information technology sector, but tend to be kind of software businesses like a Microsoft. In healthcare, but not esoteric pharmaceutical companies, more medical device companies like Stryker that makes artificial hips and knees, or potentially, you know, in consumer discretionary, which is a couple of the newer purchases we've made this year, LVMH being one of them. We tend to have very little to no exposure to more cyclical, more economically sensitive parts of the stock market. And so that means today we've got no exposure at all to energy, to utilities, to real estate or materials, and equally no exposure to financials such as banks. All those areas are very susceptible to a slowdown in economic growth. So we think our portfolio should be more resilient than the wider market if economic conditions do deteriorate from here. In terms of portfolio strategy, and I think this is probably the most important slide that we'll go through today, you know, we think some of those big risks that have been dominating markets over the past couple of years, while they're likely to abate slightly this year, they're going to still be with us for some time to come. And those are issues of high inflation, higher interest rates, and a slowdown in economic growth. A huge amount of our activity over 2022 was to make sure that we have got a portfolio of companies in all of the funds that are as robust as they possibly can be in a variety of different economic environments. You know, we say that we only buy high quality companies. I don't think anyone ever goes out and says we buy a load of rubbish, but it looks really cheap. But we unequivocally always buy high quality businesses. And so we should be able to measure that and show you how high quality the portfolio is compared to the wider market, and also highlight why we think it's going to do well in a period of, you know, higher inflation than we've seen historically and one of higher interest rates. When it comes to higher inflation, you know, we think having businesses, like I said earlier, that have got advantages that are difficult to replicate gives you pricing power. If you produce a good or a service that others can't, you to a certain degree can set the price of the product. That means that when inflation's going up, you can increase your prices without seeing a fall off in sales and protect from inflation coming through. We think the best evidence of whether our companies have got pricing power, have got the ability to offset inflation, is in their gross profit margins, which is just the difference between the cost of making something and the cost you sell it for. So our companies are typically, you know, producing something for 44p, they're selling it for £1, they therefore get a gross profit margin of 56%. The higher gross profit margin, the more pricing power you have, the more you're able to protect yourself in an inflationary environment. When we compare our portfolio to the average company in the UK market or the average company in the US market, you know, we're sitting there significantly higher today, and therefore we think unequivocally our companies can tolerate a much higher inflationary environment better than most. When it comes to higher interest rates, you know, the areas in blue on the table on the right hand side, you know, it sounds very obvious, but the best protection from interest rates being higher is making sure you've got companies that have got very low levels of debt. If you've got low levels of debt, interest rates going higher aren't going to eat into your profitability. Those first two rows on the table on the right hand side are just showing you different measures of debt, and you can see significantly less than the wider UK. So I think my thing just cut out. Hopefully you can all still hear me. You know, on interest cover, a number at 37 times is basically saying that we've got 37 times more profit than we do interest expense. So interest rates going higher isn't going to drive any of our businesses out of business. The wider market, 20% of the US stock market today, that interest cover number is below 1, which means that some of those companies can't afford their next 12 months of interest expense with their current levels of profitability, which is a pretty worrying statistic. And finally, that issue around a slowdown in economic growth. Like I said earlier, we're tied into businesses that are essential to people's daily lives. We've got very low exposure to more cyclical areas of the market, and therefore we're fairly confident our companies will weather a more inflationary environment better than most. In terms of our allocation geographically, we don't think about the world in terms of area of stock market listing, so which stock market in the world our companies are listed upon. We think about it in terms of this map of the world on the left-hand side. So on the right-hand table, you can see the stock market listing for our portfolio, so 15 or over 15% of our portfolios listed. But you can see by the sales of our companies, only 2% or just under 3% is actually exposed to the UK economy. Part of building a resilient portfolio that can grow consistently through time is diversifying revenues globally. It equally means we don't have to go and buy emerging market or Asia Pacific listed companies and get exposed to those revenues by the kind of developed market companies we already have. So we've got no Asian or emerging market companies by listing, but we still end up 20% of our portfolio sales coming from the Asian Pacific region, and that's growing by a good few percentage points every year. It's a way of us having our cake and eating it when it comes to risk. We don't get some of the geopolitical issues you get from buying companies listed in those regions, but you do get the economic growth that comes through from the consumers in those regions through businesses like Diageo, which produces Smirnoff vodka, and also Guinness beer. The second largest market for Guinness is Nigeria. So you're getting a UK listed business there, but with a deep footprint in emerging markets. And then, finally, before I kind of hand over to questions, I just wanted to highlight one of the companies that we bought this year in the portfolio. We bought in March 2022 Louis Vuitton Moet Hennessy, a French listed business, but with a very, very deep and wide global footprint. We sold Colgate Palmolive, which makes toothpaste, and pet food for LVMH because we thought we could get LVMH at a really compelling valuation. It was pricing in line with the wider market at the moment we bought it. It had fallen about 35% since the start of 2022, whereas Colgate had been flat for the year. And in LVMH, we get some really iconic brands from Dom Perignon champagne, Tiffany jewelry to the Orient Express, through the Belmond Hotel Company that LVMH acquired a couple of years ago. We're exposed to 75 global brands, what LVMH call houses, and all of those have got a very, very long vintage. There's only 5 brands in their portfolio that are younger than 5 years old, and some of their alcohol brands are in the multi-hundred years old. So the oldest brand within the portfolio, which is a wine producer, Clos de l'Ambre, is founded in 1365. Dom Perignon champagne founded in 1668. Through LVMH, we get exposure to the emerging market, but especially the Chinese consumer. And so we also are a big beneficiary through that stock of the world reopening post-COVID. Now, just to highlight, LVMH, despite some of the issues around China being in lockdown last year, still managed to grow its sales in 2022 by 23%. It's up over 47% in terms of sales since the start of the pandemic in 2019. A business with exceptional levels of pricing power, gross profit margins at 65%. And pleasingly, since we put it in the portfolio, the holdings up over 33% as we sit here today. Hopefully that gives you, a pretty good overview of what we're doing in the funds and where we are positioned as we sit here today, and equally what we're thinking about the world as we move forward.